Welcome to Qualified Opinions, where we test the ideas and limits, the knowns and known unknowns around freedom and order in contemporary politics and society. We invite you to listen as we engage with leading and emerging thinkers across disciplines and issues who will sharpen our thinking on the topics shaping our discourse. Welcome back. So today we're going to talk about something that is our fiscal situation and our, in my opinion, deteriorating fiscal situation. So in 2024, the public debt is roughly $29 trillion. The deficit is $1.9 trillion. And these numbers will be larger and even scarier in 10 years. So just to give you an idea, the debt will climb another $22 trillion by 2034. So in 10 years, right? Interest payments on the debt have skyrocketed and they consume a much larger share of our budget. And this is why I'm really happy to be talking to my two guests today who have written very eloquently recently about this topic. Josh Rauh, who I've already had as a guest on this podcast, is a Stanford University professor and a senior fellow at the Hoover institutions. Jack Salmon is a dear friend of mine, and he is the director of policy research at the Philanthropy Roundtable. I'm really delighted to have them here for this very geeky conversation. Welcome, guys.
Thanks for having us.
Hi, Vero. Thanks for having us on.
Okay, so I want to talk about our fiscal situation. And the two of you have had really worrisome blog posts over at Liberty Lens, which I believe is your Substack, Josh,
yep,
right?
That's correct.
About specifically interest payments. And some people are talking about interest payments, but I actually think considering how much they've grown and the prospect of actually interest payments becoming really a big fiscal problem for the US, I don't think we talk enough about interest payments. So, Josh, do you want to actually set the stage and tell us why you wanted these blog posts to be written?
Yeah, absolutely, Vero. Thanks very much for having us on the show to talk about this. When people talk about government debt, they tend to focus on the debt to GDP ratio. And in the U.S. in 2021, that went up to 125%. These are levels that haven't been seen since right after the end of World War II, when we issued a lot of debt to help fight World War II. But focusing on that measure can lead to a sense of complacency because Japan's debt to GDP ratio was at 244% that year, and Japan still seems to be trundling along, although they're also in deep fiscal trouble. So people sometimes look at those numbers, and of course, actually in between, Italy's at about 170%, and a lot of the European countries are at similarly high numbers to the U.S. or higher, and people say, well, look, all these countries are kind of bumbling along, so maybe the problem isn't that bad, but that is really missing a very big part of the picture. And I think the way that you can see that is if you think about how investors in debt think about the risks that they face. I'm a finance professor, as well as a senior fellow at the Hoover Institution, finance professor at Stanford. And one of the things we teach a lot about is debt markets and what investors tend to look at in debt markets. One of the really important things that investors are going to look at is not so much what is the debt to assets or debt to income ratio of a company, but they want to know whether the company can cover its interest payments with the cash inflows that it's getting, whether it's earnings, or more specifically, actually, its cash flows are going to be sufficient to pay for the interest that it's paid on its debt. And what is that ratio? So I think it's that type of thinking that led me and others to really say, okay, where is the U.S. government on interest coverage? And there the picture is really dire and really sort of uniquely dire in the world. And the reason is that interest rates in the United States have come up quite a bit as the Federal Reserve has been working on fighting inflation. Now we think maybe we've peaked on that and that interest rates might be coming down a little bit. But it's just sort of a slow-moving effect of the Fed increasing interest rates on the cost of servicing that debt for the U.S. government. So in the blog post, I just did some simple calculations based on Congressional Budget Office projections, and also did a little bit of stress testing that others don't generally tend to do, asking what would happen if interest rates were just a little bit higher. And I actually scared myself with
well,
what
you
I
scared
found,
me.
which is sort of hard to do because I generally think of myself as being pretty hardened about these things and knowing how bad the fiscal situation is. But basically, even currently, you've got interest payments to government receipts at around 19% for 2024. And if you project this forward, it rises very dramatically under projections, economic projections that the CBO uses. If I just take sort of their time series and calculate that coverage ratio out, goes up to about 23% in 10 years. But then if you just stress test that a little bit, and I'll let Jack talk about the interest rate assumptions that underlie those projections. You just stress test that a little bit and ask, what if interest rates are a percentage point higher or 2 or 3 percentage points higher over the next, say, 30 years? These interest payments really blow up as a share of our government receipts. And you just got to ask, how much longer will credit markets continue to loan the U.S. government money when they know that for every dollar of revenue that the government is bringing in, 20 cents of that is going just to pay interest on the debt? It's completely unsustainable, and it's just very, very fragile.
So before we actually dive into those numbers and the stress test that you did, and also, of course, about why actually the stress tests that you did are probably closer to the reality based on Jack's work than the CBO projection right now. I want to talk about why there was this complacency. Really, I mean, we were very complacent about payment under debt, interest payment on the debt. So, Jack, do you want to kind of maybe, like, you and I have written about this, right? I mean, like, it used to be that interest payment on the debt, they didn't really consume much of our budget. Do you want to give us like a little recap and why that was?
Sure. I might start a little bit earlier on this question in terms of the sort of economic historical context. I first became interested in economics in high school. I was studying in high school. And at that time, I remember a lot of European finance ministers would use this excuse of low interest rates to justify their debt ratios that had, at that time, were exceeding 100%, heading towards 150, 200%. And then when I was in college, the European sovereign debt crisis hit, and I was studying economics in college. And so when I was hearing these arguments in the years preceding the pandemic, 2019, we heard a lot of economists saying things like, there's no risk of an interest rate spike. Interest rates have been falling for decades, and this is a trend that's going to continue into the foreseeable future based on several different structural factors. I started to get a bit of deja vu. I know that the US isn't the same type of animal as many European nations. It is the global reserve currency, and it has some factors in its favor. But the risks are still very real. And we've seen that pan out over the last few years. We used to spend, it wasn't that long ago, only a few years ago, we were spending $300 billion on interest payments every year. I think we clocked in just under $900 billion this year. So we're likely to pass $1 trillion pretty soon.
I think by the end of the decade, we'll be paying $1.8 trillion. And that's making assumptions about the state of the economy and about the level of interest rates and inflation, of course.
Yeah, those are the rosy assumptions. So that's probably the under. But there's also the issue of the sort of maturity structure of the debt. I always talk about this, and I say that we're only beginning to see the sort of tip of the iceberg in terms of this fiscal cost that is coming out of this spike in interest rates we've seen in recent years. I mean, the entire yield curve this morning is above 4%. The 10-year Treasury is at 4.3. This is our time where the PCE is now down to essentially the Fed's target, and so we can't use inflation as an excuse going forward. And so the real issue is, number one, there's the public crowd out that this has. There's the government crowd out. This being more money diverted towards paying off the nation's debts means less money available for other political promises that we hear about. But the other impact that I'm more concerned about is the impact on the private sector and how this crowds out economic growth. And I've written a lot on this subject about how the rising debt ratio and the subsequent change in interest rates diminishes economic growth potential, as there's less capital for each worker, And so we have slower growth going forwards, because another aspect of this, we haven't heard many political talking points in this campaign about the debt issue, but when it has been asked, we're often told, well, we'll just grow our way out of debt. Well, I mean, it's just
yeah, it's not going to happen.
Financially impossible.
It's interesting. There is a tension in that economic setting for interest rates and for the budget. I think on the one hand, some people, including the CBO and Jack, this goes to your excellent piece, sort of claim that some of these weaker growth headwinds are going to allow the Federal Reserve to keep interest rates lower. And that's going to mean that those interest payments that the government is making aren't going to explode quite so much. So we shouldn't be so worried, because some of these kind of slow growth factors are going to allow for those rates to stay lower. But on the other hand, the worse the economy looks, the more worried the buyers of Treasury debt, whether domestic or international, are going to get about just how committed the U.S. is to paying off, to servicing its debt in sort of non-diluted nominal dollars, and that would then lead to their wanting to charge a premium to us on our debt. So that tends to increase. That would tend to increase interest rates. So
So I want to actually talk about this. It's like I want us to really spell out, why is it that we're looking at interest payment? What is it about interest payments that is so important, right? What happens when we don't pay our interest payment, right? Can one of you just very spell out, why is it that we're so why is it not Social Security, for instance, right? And actually, we can talk about Japan in this case, right? And why are we more worried about the share of interest payment than we are about what we are worried that? Three of us certainly are worried about how much Social Security payments consume as a share of our budget and of our revenue, but we have a particular place in our heart about interest payments. So, can one of you take it on?
I'll take a quick attempt at that, and then see what Jack thinks. I mean, I would say that the interest payments are an actual contractual obligation that we have. Not only to domestic investors, but also very largely to international investors, foreign investors, in many cases, foreign governments. We've promised we're going to pay them. This is part of the debt contract, is that there's interest payments and there's repayment of principal. And so it's that hardness of those payments. It is in theory possible for us to reform Social Security. In theory, possible for us to reform Medicare if the political will were there. But the basic problem is that if you look at these projections, there just aren't enough dollars to make all of these commitments, to pay the interest and to pay Social Security and Medicare and for all of the government spending that we've got. So as international markets worry that they're going to be deprioritized in that, and that we're going to make those payments with potentially dollars whose value has been diluted through a lot of inflation, they then charge us even more. And those interest payments become even a greater part of the budget. And then the federal government doesn't have the leeway to do anything else. Like, for example, potentially we might have to ramp up defense spending for some reason. Or there may be other reasons that we need to have some flexibility in spending. So those interest payments really take away any flexibility that we have to increase spending on other things. That would be my approach.
Also, isn't it the case that the consequences would be dire if we actually don't meet our promise to repay interest on the debt? While, the political price may be really big of reforming Social Security, cutting a lot of spending, but the consequences, the financial consequences, may not be the same. Will not be as tragic. At least it's the way I think about it.
Well, we'd be cut off from global debt markets for a time. I think the more likely scenario, rather than our just saying, we're not paying the interest payments, is that we pay them with inflate, with dollars whose value has been diminished by inflation, and that essentially we just do the equivalent of printing a lot of money make these payments. So it's
That's a form of default.
A form of default. Mm-hmm. Yeah, it's a slower form of default. And the consequences then are that we get charged even more on global markets if we want to be able to finance our operations. And that ripples through the whole economy too. It's not just the federal government's interest payments, because all interest rates in the economy are tied basically to the sovereign interest rate.
Yeah.
And so
yeah. No, I mean the consequences of not repaying, or even repaying with deflated money, is actually I can't even wrap my head around how bad that would be. In fact, this is why, right, when we have conversation about the debt ceiling and making debt payment a priority, it's because of that, right? It's just because the consequences would be really dramatic. So let's dive actually about the specific of both your papers. So, Jack, I want to start with you, and then I want you to to explain to us what is CBO looking at when it's, I don't want you to tell us what they get wrong, but just what is CBO doing in order to project our debt, like what's the debt, the path of the debt looks like, and what interest payment will look like going forward. So what is it that CBO looks like? And then Josh, I will come to you and then ask you after, under these assumptions, what does it look like, right? And how did you stress test those assumptions? And then we'll go back and get Jack to tell us why, you may be right with that stress test. So Jack.
So in terms of the debt trajectory, the CBO takes a sort of a high-level, broad look at sort of different macroeconomic variables going forward, which include inflation, interest rates, economic growth, projected spending and revenues based on current law. But what I looked at specifically was the factor of interest rates, because it plays a key role in their projections. And they typically use an estimate of, so when looking at the relationship between debt and interest rates specifically, which is what I was primarily focused on, they estimate that every 1 percentage point increase in the debt ratio raises 10-year yields by about 2.5 basis points. That's traditionally what they've done. But as I dug deeper and deeper into the latest long-term budget projections, I found they've actually revised that downwards to 2 basis points. So they're actually estimating a very small impact of debt on long-term interest rates. And so what I did was I reviewed the empirical literature on this issue, going back about 2 decades. The early literature tends to found estimates between 2 and 3. And so this was already showing 20 years ago that this is the estimate they're using is sort of a lower bound estimate. But the more recent studies I've seen, more comprehensive, that use more up-to-date data sets and new methodologies, they tend to find about 4 or more basis points for every 1 percentage point increase in the debt ratio. And so I just applied those small differences to the current projection, and it raised interest rates over 30 years from less than 4.5%. So in 2054, the 10-year yield being about 4.5% in the latest CBO budget projection. And if you applied the more realistic debt impact effect of 4 basis points, it's closer to 6% yields on the 10-year treasury, which is a significant difference. And that would really have an upward impact on the debt ratio, on the servicing costs, and detrimental impact on the broader economy. But I also looked at the other structural factors that they consider. They consider, I think it's 6 different structural factors on the debt. Now, many of the other ones put downward pressure on interest rates, and they've done so over the past few decades. There's a lot of literature on this. Demographics is one. So an aging population, baby boomers with their increased savings have put downward pressure on yields. But they seem to assume that these trends we've seen since about 1980 will continue into the foreseeable future. And now the literature on this isn't quite as clear-cut. Mm-hmm. There isn't really a consensus on that. Some studies assume this is the case. Others assume that it could actually have upward pressure on interest rates going forward as baby boomers begin to spend their retirement savings. And so it's more unclear in terms of the other structural factors.
So Josh, just assuming, like what is CBO saying is going to happen to interest rates. And as a result, well, first you make the case that the way we should be looking at it is not just interest payment, the nominal amount, but it's really interest payment as a share of revenue.
Exactly.
Right. So can you remind us, right, it's going to be roughly 20% of GDP, 20% of revenues next in 2025. How does this compare historically to, have we already, this has happened before?
Well, historically, I mean, if you go back to, we're crossing a threshold that we were at in the late 1970s and early 1980s, when debt was a lot lower, but interest rates had to go up a lot. The Fed raised interest rates a lot in order to fight inflation, and so, but they never crossed 20%.
So we're crossing this line. Is it the first time ever?
If you go back to World War I, it got to these levels, but not much higher. And it also depends on, actually, I'm working on doing some long time series calculations that are on a consistent basis with the net interest basis that the CBO does to be able to say exactly. But we're at levels that that have not been seen by the U.S. except possibly during wars like right after wars. I'll say, I mean, another nice comparison is just looking at other countries. I mean, Jack mentioned, we're not. We have the dollars, the reserve currency. We're not the same as other countries, but everybody knows about the Greek debt default and the Greek government fiscal crisis in 2012, 2011, 2012, and at that time. In 2011, Greek interest payments, the share of their revenues, reached 17%. I mean, we're beyond that, and so we're looking at numbers that you really only see in countries that have got that are in serious fiscal trouble. I also say just one other comparison point. Sometimes I start talking to people about this, and they say, "Oh, yeah, but the European governments. I mean, they're all fiscally profligate." As well. Well, let's look at France. Okay, I mean, in France, in 2024, they're going to have about 48 billion euros of interest payments on about 1.6 or 7 trillion dollars in revenues. Yeah, that's 3% of revenues going to interest for France. So we've moved into a really bad regime here.
And the thing is that, precisely because of our situation and because of the high demand for U.S. debt, I mean, every government around the world is going to be affected if we start finding ourselves in trouble with repayment of those interest payments, right?
Well, right, because I mean, around the world, many people hold our debt, and so there's definitely a ripple effect when that debt is not fully repaid in dollars that are not devalued. And
so 20% in 2025. This goes up to what, 23%? You said at the end of the decade.
So if you just take the CBO's own projection series and you calculate this ratio, I found that it reached 22.9% by 2034. I should note, I mean, the CBO doesn't make this calculation for you, right? They provide the data that you would need to make the calculation, but they're not the ones that are making the calculation. I think they might not want to be drawing attention to this.
Yeah.
And if you exclude revenue from Social Security from that denominator,
I thought was super interesting.
Well, yeah, because as we know, so I mean, Social Security already, even under just the current amount of revenue coming in, would have to have around a 20 to 25% cut in it when the trust fund runs out in about 10 years. So we'd be deluding ourselves really to think that there's going to be a lot of that revenue available to pay interest. So it seems reasonable to also do at least an alternative scaling where you're scaling not by total revenues, but by revenues excluding Social Security. And there, the interest payments reach 31% of the remaining revenues. Again, under the economic projections that the CBO puts forward. And the key economic projection, as Jack said, is the interest rate. And I think what's really fascinating is that if you look at the CBO's underlying macroeconomic projections, they've got the average interest rate on the federal debt hardly budging over the next 10 years. They have it at 3.36% in 2025 and 3.38% in 2024. And of course, that's not exactly the same thing as where's the 10-year Treasury yield, because that number represents both, well, it's the average of both, shorter term and longer term debt. And it's a question of when the debt, as Jack was talking about, the maturity structure of the debt, when it gets rolled over, whether they've got a lot of short term debt, a lot of longer term debt, but they've got that interest cost just basically flat over 10 years. And it was looking at that where I thought to myself, what if we just stress tested that a little bit?
Yeah. So, and Jack, in your piece, you actually point to the fact that the path of the interest rates for the next, is it 10 years that you look at versus the past is almost the same, which is kind of weird because our debt has exploded during COVID. We've experienced inflation. So for all the people who thought that the era of inflation was over and we had conquered inflation, and what's more, like if we had inflation, the Fed had the tools to take it, to crush it easily, right? We've learned that this is not the case. So it's kind of, you would expect CBO to kind of actually price that extra knowledge into, but then there's very little difference actually between the path of interest rates going forward and the path of interest rate of the past, right? Do I remember that correctly?
Yes. So that's actually what got me going down the sort of rabbit hole of the underlying assumptions of this long-term budget projection, because I was reading the budget projection, particularly the interest rate part of the story, and it said that interest rates are forecast over the next decade to be about the same as they've been over the past 3 decades, the average over the past 3 decades, and that 30 years out, they're only expected to be about a third of a percentage point higher than that average. This just seemed sort of absurdly wrong, too much of an underestimate. So that's when I started digging into, well, what are the structural factors they're considering? What does the literature say? Why are they revising down this debt impact parameter in their measurement? And so that's how we sort of got to this story.
And I mean, and the gap is quite big. So you do a review of the literature of the past and more recent literature. You say the interest rates or the impact of the debt on interest rates. So that's going to be interest rate above the current path of interest rates, right? So it's basically what you're looking at is a literature of how much worse can it get compared to what is projected now, right? And you look at this and you say actually kind of CBO has a very, very, they have a very low, they're low balling basically the impact of debt growth on interest rates. So their range is between 2 and 2.5, right? For every percentage point of debt to GDP to go up, you would have a 2 to 2.5 growth in basis point. And you're saying the literature is more around like 4? Is that what you find?
Yeah, it's actually above 4. I'm being a little conservative by saying 4. It's typically 4 to 4.5, but I'm using 4 just to be sort of more conservative in my estimate. And it is on top of the sort of current trajectory, but it's assuming all other factors are sort of equal. So even if we assume the other structural factors will continue to put some downward pressure on interest rates to sort of counteract some of that debt impact, the debt impact is almost 300 basis points over the coming 30 years. So that would have to be a lot of downward pressure from other factors.
Yeah. So that actually puts us in exactly the territory of the stress tests that you put, that you played with, Josh, if I remember correctly. So as a reminder, you say, let's look at interest payment as a share of revenue next year and in 30 years. Then second phase, you say, let's look at interest payment as a share of revenue while if we exclude basically the revenue that have already been earmarked for Social Security, and you look at it for 2025 and in 30 years. And then the last test that you put in place looks at what if interest rates are 1% higher every decade than what they are projected to be now. And you repeat this for 3 decades, right? So that was the really scary part. I mean, the other part, it was scary enough, but this was very scary. So can you actually...
Right. So if the average interest rate on federal debt is just 3 percentage points higher in 2054 than the CBO is projecting, and the CBO is projecting through 2054 only a very small, maybe 50 basis points higher rate on the federal debt than today. But if it's an additional 300 basis points higher than that, then you end up with an interest to revenue ratio under current law of 62%. And if you exclude the Social Security payroll tax in the denominator, it's almost 82%, 81.9%. And these are not, I should say, I don't think these are particularly extreme scenarios, both for all the reasons that Jack set forward, but also, if you look at history, the interest rate, the average interest rate of federal debt in 1982 reached 9.2%. In my post, I didn't ask what would happen to interest coverage if the average interest rate on federal debt reached 9.2%. I didn't even ask what would happen if it reached this 1991 level of 7.2%. I just asked what would happen if it's 300 basis points or 3 percentage points higher than the CBO current projection, and that would get you to an average rate of 6.8%. So not even up to the level of the early 90s, not even up to the level of, certainly not up to the level of the 80s when it was even worse. So these are scenarios that have actually been seen in recent history. And I have a question. Maybe Jack, you know this, but this use of 30 years of past history that the CBO and others seem to do, that seems to be a very convenient cutoff point. I mean, 30 years ago was 1994. That was just like right when interest rates were really starting to fall. I mean, if you just put another 10 or 20 years on the back of that, you'd be averaging in a time period when interest rates were quite a bit higher because of the inflation fighting that the Fed was doing, and other other structural factors that push rates up.
Jack?
Yeah, that's a good point. That was a period of obviously stable economic growth, low inflation, lower interest rates. I wonder if they moved it back a decade, how that would change things. But that's it seems to be the sort of 30-year window that they're looking at when making these comparisons. But again, I mean, if they're using that 30-year window of low interest rates and saying that the next 10 years are going to look similar, it's highly doubtful. I mean, just given where we are, the situation we're in, and what the direction these structural forces are moving. I just want to add something because you mentioned interest rates sort of peaking in the early 1980s, but this is another issue where the sort of structural maturity of the debt comes into play, because even though interest rates spiked in the first half of the 1980s, we didn't see that in the budget until the early 1990s, because it typically lags by about the average length of the maturity of the debt. And so,
well, for one thing, the Fed alone doesn't control interest rates. They may be raising rates, but the reality is that bondholders who had been burnt in the 80s, they took some time to actually say, okay, we can chill and agree to lower interest rates that we're asking for, right? There's this kind of idea that the Fed is all powerful and whatever, that once the Fed decides to actually lower interest rates, that's it. Rates are...
Yeah, good luck with that. That's not going to happen. And it didn't happen in the 90s. In fact, as rates came down, the debt servicing costs went up. And it's because of this lag. It's because of this rollover. We're not only issuing more debt and creating these deficits, but we're also refinancing existing debt into higher yielding treasuries. And so even though all of the entire yield curve is above 4%, the average interest rate we're currently paying on all of our debt is about 3.3, a little more than that percent, but it's going up every single month. And so the ultimate pain of this spike in interest rates we've seen over the last couple of years is actually going to be peaking at about another 5 or 6 years out. And so this is really going to be a longer period of pain than many of the sort of economists and policymakers in this space.
And that's, of course, assuming that we're done with inflation and that interest rates are going to, to follow the path of the 80s and 90s. Obviously.
And it's actually cheaper to service a debt ratio that's 25% at 10 or even 12% interest rates versus servicing today's debt at 4% rates?
Well, that's the thing that actually I find amazing, which is because our debt is so much bigger. We're at 100% of debt to GDP. As I said, we're like our debt is roughly 29. The public debt is $29 trillion, right? I mean, back in the 80s, it was between 20 and 25% of GDP. And they got into enormous trouble, financial trouble. Yeah. I mean, it was just and this Jack knows this, but I mean, Jack and I have spent so much time arguing with really good economists otherwise, who were saying, just don't worry about it. Interest rates are low and interest rate will stay low. And some of the things that we would respond would be like, first, never say never, right? This notion that this anomaly of the last 20 years of having low interest rates that really don't budge much. Even when we had a little bit of inflation after the Great Recession, they've continued staying down. In fact, the Fed would have liked to see inflation a little higher, but rates were really low and everything, So it was an anomaly in the history of the U.S. But this notion that you could just bet on they will never go back up again is one thing. But we were also saying, you know what? Even if interest rates stay low, the bigger our debt, the bigger those interest payments. I mean, small interest rates on larger debt means larger interest payments. And it really wasn't so long ago that you and I, Jack, were writing about the fact that no, we just shouldn't actually be totally complacent about the debt just because interest rates are low now. So it's kind of maddening because we always knew what the path of the debt was looking like. So do you think people are realizing? What's your sense, both of you, about how serious people are taking this?
Well, can I just point out real quick also, as Jack pointed out at the beginning, currently basically the entire yield curve is around 4%, 10 years around 4.3%.
Maybe explain to people who may not follow this, may not be as geeky as we are, what's the significance of this is.
Yeah, well, I mean, this just means that whether the government is borrowing now for 3 months or 6 months or a year, or whether they're borrowing for 10 years, they're paying roughly the same annualized interest rate, and that's 4.3%. And again, the CBO's baseline assumption is that the average rate of federal debt is going to remain where it is now, which is at 3.3%. And even if you just do that stress test, which is not nearly as large as the very plausible 3 percentage point higher one that we were discussing before, that's much bigger. But if you just do that, the numbers are also very bad. By 2034, you've got 40% of non-Social Security revenues going to pay interest. So I just want to emphasize that the rates don't have to go up by that much to really blow up the deficit. And as for, I think you're getting at the question of what market participants think and are doing. The fact that these yields still are where they are indicates that on average in markets, there's less concern in these markets than the three of us have sitting here. And interested to hear your thoughts on that. I mean, the way I look at it, if you look back to right before the fiscal crisis in Greece in 2010, I mean, there was basically no yield spread between Greek bonds and German bonds. There were a lot of structural factors. There was a lot of belief that European Central Bank or other sort of European institutions would always kind of hold these things together. That was a situation where there was uncertainty about what how much heft this newly kind of created sort of central government of Europe actually had, or growing central government of Europe actually had. Whereas, the United States, we have a much longer history. But, I just think the risks are really skewed on interest rates to there being much higher. But, people would say, if you think you know where interest rates are going, why don't you borrow as much money as you can and go short treasury bonds. And there are risks in both ways, right? I mean, we can't predict these things for sure, but this fragility, I think, is the real point. It's very sensitive. Even just small increases in interest rates, we're in deep trouble.
So, I mean, Jack, do you have something to say? Because
I just wanted to, first I wanted to add something to what Josh said about in explaining what we mean by the yield curve being above 4%. Just another way to explain this is when the Greek sovereign debt crisis happened, Josh mentioned they only ended up spending about 17% of revenues. And one of the reasons it wasn't as burdensome is their longer term treasuries were actually at much lower rates. So they rolled a lot of their debt over into longer term treasuries so they could avoid those higher interest rates. We haven't got that option because even the 30-year treasury is way up 4.5%, somewhere around there. So we haven't got that ability to roll over. And this really adds up quickly.
That's what we should have done.
That's one of the options.
That's what we should have done in the last 10 years.
In March 2020, the 30-year treasury went below 1%.
So that's what we should have moved everything there. Instead, we went the opposite direction, right?
In September alone, we rolled over $2.56 trillion of treasuries. And so that's being rolled over now into treasuries that are 4% plus. And maybe those were previously at 1% or even lower. And so this is, as you can imagine, this is obviously spiking the average rate because we avoided doing that quick fix solution. Your other question was about.
By the way, can you please remind people, because I think we really should remind people, what's the maturity of our debt? Like the average, but also what's the share of our debt that's less than a year of maturity and less than 3 years? Because I think people don't actually know that.
Yeah, the average is I think it's 71 months. The last time I looked at the quarterly refunding from the Treasury, that's so short. It's just under 6 years, and it's been that way for a long time. I mean, even if you go back to the like we're talking earlier about the 80s and 90s. It was quite similar. 5-6 years has been quite normal, and I can't remember what share. About a third rolls over within 1 year. So every year we're rolling over a third of our debt into these new.
And
interest
a lot
rates.
Of that is actually 2 weeks and 3 months,
shorter than a year. So up to a year, and then about 54% of all of our debt is 3 years or less. So it's incredibly short term.
Yeah. So to answer your question, Josh, I was here's what I learned that I did not know. I have this great faith in the market, and I do, and I really do. And in fact, certainly, I think this is the best thing we have to actually kind of like prices are just remarkable in carrying all this information. But one of the things that I've learned the last 4 years, right, is that for things that are like predicting inflation, but also predicting rises in interest rates, the market is the best we have. But it still doesn't have a crystal ball. So one of the things that Jack and I, when we were in 2021, when we were like, we think there's going to be inflation. Look at this output gap. Look at how much money they're pumping into the economy. We weren't still yet versed in the fiscal theory. We were still kind of looking at the, like in a Keynesian way of things like this. Like we had economist friends who was like, look at the expected inflation, blah, 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 blah. And what I've learned to say at the time was like, well, what I've learned from the past in the 80s is that actually expected inflation changed only when inflation was there. And the same happened in Greece with interest rates. Interest rates were low until they weren't. And it's not as if it kind of gradually goes up. It's like all of a sudden expectations change, and often they change because of knowledge on the ground, and it happens overnight. So the fact that I'm not more at peace thinking, oh, look, the market is kind of thinking that eventually Congress is going to do something to address this. I think they have legit reason to think that in the past they've tried to avoid catastrophes and all this, but there's the problem is like the moment they're going to change their mind about this particular point is going to happen really quickly. And this is why when I was reading your piece, I was like, freaking out even more than I was. But I want to be conscious about your time. So anything else you want to say in terms of concluding remarks, Josh, on this topic?
Well, I would just say that, there has always been an opportunity for Congress to take action on this, but the political will just hasn't been there because it involves cutting spending, and cutting spending is always politically unpopular, and there's just no way around this without really reducing spending programs. And it may be that what's going to happen is that the market is going to force us to do it, because at some points, these rates are low until they're not. I mean, until the market loses confidence that Congress will actually do something at the right time. So I guess my forecast is that over the next coming years, I would say we're not very far away from this. The next 5 years or so, we're really in a situation where we could very well see the market, really showing that they're not willing to buy treasury bonds at these rates, charging us much higher interest rates, and really, forcing something to happen. It would be nice if it didn't come to that. And the silver lining I always give is there is a ton of wasteful government spending out there to be cut if we would cut the right stuff. If we would do it in a calm way, without being put under a lot of pressure, cut the right stuff that's actually inefficient spending. There's a lot of it out there.
Yep.
Then we could do it in an orderly way. That it would be much better to do that than wait till the market forces us to do it by creating a debt crisis, which is going to hurt everybody with much higher interest rates and really bad economic consequences.
Yeah. And Jack, do you have a message for CBO?
Well, most countries that have actually implemented sort of spending control or some kind of structural reforms or fiscal rules, they often hit a crisis level. And so that's the sort of pessimistic take on this. It's similar to what Josh said. But I'm what Matt Ridley would call a rational optimist. And so I'm hopeful that we can reach something like we saw in the 1990s, when interest rates actually put political pressure for changes to be made. But I would say to the CBO, to be fiscally prudent, you should always assume some of the worst assumptions when building your models, not just sort of take the more rosy assumptions when sort of building these things out. Because if we get to that point, it's hard to make adjustments.
Well, thank you guys. This was great. Depressing, but great.
Thanks for having us.
Thank you very much, Vero.